Most traders keep missing high-probability fair value gaps because they don't know how to filter the weak ones. A quick search online will show countless strategies, but let's be real, most don't work. Trading has the potential to generate money with just a click, but only if you know how to spot the right setups. And here's the catch. Most traders are marking the wrong gaps without even realizing it. So in this video, I'll break down exactly what a fair value gap is and reveal 5 powerful hacks to identify only the strongest setups. Stick with me, and by the end, you'll be spotting them with precision. Let's dive in. First, let's break it down. What exactly is a fair value gap, and why does it matter? Fair value gaps are chart imbalances identified by a 3-candlestick pattern, but not all gaps are created equal, and that's where most traders get it wrong. Understanding the right gaps to trade can mean the difference between catching a high-probability setup and stepping into a trap. For a bullish fair value gap, the first candle's high doesn't overlap with the third candle's low, creating a visible gap. The market often retraces to fill this gap, either partially or completely, before resuming the trend. But how do you know which gaps are strong enough to trust? The opposite is true for a bearish fair value gap, where the first candle's low doesn't overlap with the third candle's high, leaving an imbalance that attracts price movement. These gaps act like magnets, drawing liquidity and creating key zones that traders can use for entries and exits. Now that you understand what fair value gaps are, let's get into the 5 hacks that will instantly improve how you identify and trade them. Hack number 1. Prioritize the bigger fair value gaps. If you see multiple fair value gaps forming in one setup, always focus on the bigger ones. Why? Because larger gaps indicate a stronger imbalance between buyers and sellers, making them more likely to act as strong support or resistance levels. But size isn't the only thing that matters. Location is just as important. Hack number 2. Location is key. Use Fibonacci to filter out weak gaps. Sometimes, you'll see multiple fair value gaps of similar size, making it tricky to decide which one to trade. Here's the secret. Gaps in the lower portion of a move tend to perform better for buys, while gaps in the upper portion work better for sells. To pinpoint this with precision, use the Fibonacci tool in TradingView. Adjust the settings to include price levels at 0, 0.5, and 1. Then, drag it from the swing low to the swing high of the movement containing the gaps. The middle line acts as a divider, helping you focus on the fair value gaps in the bottom half, while disregarding those in the top. For short trades, reverse the process. Drag the tool from swing high to swing low and focus on gaps in the upper portion. Hack number 3. Use Consequent Encroachment to confirm strength. Now, here's where things get really interesting. Just because a fair value gap exists doesn't mean it's tradable. You need to check if it respects Consequent Encroachment, CE, the midpoint of the gap. If price touches the wick and closes above the body in a bullish setup, it signals a strong fair value gap. If price breaks the wick and closes above the body, it's a potential buy signal. If price closes below the body, the gap is weak and should be avoided. To find CE easily, go to TradingView settings and turn on the middle line option. If price respects CE and bounces, that's a confirmation to trade in the direction of the trend. But if price breaks through CE and fails to recover, the fair value gap has failed. Hack number 4. Multi-timeframe confirmation. How to find the best entries. Spotting a fair value gap on a higher time frame is great, but how do you turn that into a precision entry? Here's the step-by-step process. Start with a 1-hour time frame and identify a fair value gap in an uptrend. Wait for the market to return to this gap, but don't buy just yet. Drop down to the 5-minute time frame and wait for a structure break. Once structure breaks, mark a new fair value gap on the 5-minute chart. Take your entry confidently, knowing you have confirmation on both time frames. This method filters out low-probability setups and ensures you're only trading high-conviction zones. Hack number 5. The Golden Zone. The ultimate confirmation tool. The most powerful fair value gaps appear right when structure breaks. This is what we call the Golden Zone. Here's how it works. In a bullish market, price forms higher highs and higher lows. When a previous high is broken, look for a fair value gap in that area. Wait for price to pull back into the gap before taking a buy entry. This strategy aligns your trades with smart money, giving you the best chance of catching explosive moves. Now that you have these 5 powerful hacks, you're already ahead of most traders when it comes to spotting high-probability fair value gaps. But here's the real game changer, knowing how to apply them with advanced strategies. In the next video, I'm breaking down 4 advanced FVG strategies that will take your trading precision to another level. But there's a catch. I'll only release it when this video hits 30 likes. So if you want to see exactly how to combine these rules into a winning system, smash that like button and drop a comment below on what topics you want me to cover next. Let's make it happen. On fire.